Hello everyone and welcome once again to the OANDA Market Snapshot. My name's Craig Erlam, Senior Market Analyst here at OANDA. Now we'll start today with a look at all the economic data and events that we have. The real standout one, I can't obviously go into all of them, this is just a quick snapshot of the day, but I think the most important event and the one that's really had the biggest impact on the markets is of course, as we were anticipating, the Bank of Japan interest rate decision and monetary policy statement. Now like I say, the biggest moves that we've seen in the markets today have come in relation to that. The Japanese yen is currently up between 1.5% and 2% against the euro, the pound and the dollar. This came off the back of a disappointing stimulus package. Now there's a couple of things to point out in relation to this. Firstly, let's just go into the actual stimulus itself. There's two key points to the stimulus. The first is the fact that the ETF purchases, the pace of ETF purchases were doubled or almost doubled from 3.3 trillion yen to 6 trillion yen, which is about $56.7 billion. The other is the fact that the size of the lending program for local companies was doubled to $24 billion. This effectively provides US dollars to Japanese companies in a bid to support their overseas activities, which I guess will help protect them during these periods of currency fluctuations and an ever-strengthening Japanese yen. Like I say, these were the two key stimulus packages, I guess, in the that came from the latest monetary policy decision. This was quite disappointing from the market's perspective, and like I said, there's really two ways to look at this. One is the fact that what the markets were looking for was more QE. They wanted to see an increase in the monetary base, which is currently lies at 80 trillion yen a year. That was unchanged, so that remained exactly the same as it was. And they were also looking for potentially an interest rate cut from the current levels of minus 0.1%, but again that stayed exactly the same. So what we've got is these more obscure methods of providing monetary stimulus to the economy in a way that the markets really don't see as being that valuable in terms of weakening the Japanese yen, and potentially maybe don't even see as valuable in terms of providing that extra growth and providing that extra inflation in the Japanese economy. So there was a big disappointment really to this, and this is why we saw the strengthening of the yen, because it really didn't fall in line with expectations, particularly given that we'd seen this big fiscal stimulus package announced by Shinzo Abe, and what people were hoping for was that the Bank of Japan was going to match this in a real strong bid to hit its inflation targets. And instead what the Bank of Japan has effectively said is, we're really impressed with what the Japanese government has done, so we don't feel like we need to do quite as much on this occasion in order for the inflation target to be hit. And it does think it's going to hit its inflation target in 2 years' time. So clearly the Bank of Japan thinks it's doing enough in what it's done, but the markets would appear to disagree. The second point in this is a transition which I think is happening with regards to the central banks on what their focus is, but also what the government's focus is as well. What we've seen for so many years now is that while we've seen fiscal consolidation amongst the governments around the world, and the job of growth and inflation and recovery to an extent has been left primarily to the central banks to provide this monetary stimulus in order to try and get the economies going again. There seems to be more of a joined effort amongst the central banks and the governments. Less pressure being put on the central banks, but more pressure on the central banks comes from like opening the credit channels and providing a supportive environment, which we can then be helped or aided by the fiscal stimulus programs, which we are now starting to see. The UK government is expected to announce some form of fiscal stimulus measures in order to try and give the UK economy a boost after the Brexit vote. We heard from Mario Draghi last month, who pointed at the moderate expansionary fiscal policies of the European governments, which you can see has effectively enabled him to focus less on, say, quantitative easing, but focus more on improving the credit channels through TLTROs and other form of monetary accommodative measures. And now we're seeing the same thing, it would appear, from the Bank of Japan. So I think maybe we're transitioning into a different phase, and rather than look towards these central banks to provide these big, aggressive and very open monetary stimulus packages that the markets both understand and can easily be simplified, and we know what we're looking for. We're looking for QE or interest rate cuts. It looks like the central banks are now exploring other more unconventional and maybe less explosive avenues as means to the same end. So it'll be interesting to see how the markets continue to react to this going forward, and really how they start to anticipate them ahead of the decisions themselves. We know that the Bank of England, for example, on the 4th of August, so next week, is expected to announce some form of monetary stimulus. But is it going to be the interest rate cut that people are pricing in, or is it going to be more quantitative easing, or are we going to still look now more towards things like the funding for lending scheme and maybe more other unconventional measures that can work alongside some form of fiscal stimulus package from the government? And if we do get the more unconventional measures that we haven't become accustomed to, how will the markets react to that as well? So I think interesting times lie ahead for these central banks, and maybe we need to start changing our views on what we're expecting from the central banks, because now it's no longer just down to the central banks to provide support. Hopefully the governments are now in a position where they can aid the process as well. Like I say, so we've gone into a lot of detail there on what happened from the Bank of Japan, so I'm not going to spend too much time on the rest of this data. There was a lot of data due out today, but I think this has been put on the back of people's minds, I guess. Things like retail sales from Germany, GDP from France and Spain. The Spanish GDP was 3.2% on an annual basis, which is strong figures. The unemployment rate in the euro area was the same. No big surprise on the inflation or GDP front in the euro area, although GDP did halve in the second quarter, but that was in line with expectations. If we look at, say, what is to come, again, there is going to be a focus on the data. GDP for the US, I think, is going to be important. We know that the Fed is probably going to be open to an interest rate hike in the second half of the year, probably later on. But if we do see GDP picking up and accelerating in the second quarter, carrying over into the third quarter, then that may bring forward expectations for some more for this tightening process. Prior to that, if people can buy into the possibility that the Fed would move prior to the US elections in November. We do have things like employment cost index, which is a notable economic release, and things like the University of Michigan consumer sentiment reading, Chicago PMI, etc. All of these are going to be notable. The Baker US oil rig count, I think, is going to be extremely key. We've now had a few weeks where the oil rig count has risen. This could potentially lead to this oversupply flooding back into the market in the coming months between now and the end of the year. I think the real key thing before now and the end of the day, though, is going to be the European bank stress test release. That comes later on tonight, so just before the Forex markets close. So I think we'll see the full impact of this on Monday morning, depending on how they do. I think there's going to be a focus clearly on the Italian and Spanish banks in particular, but things like Deutsche Bank as well. We know that they've had a very rough year, so it'll be very interesting to see how they survive these tests as well. It's worth noting that this isn't going to be a pass or fail type scenario, so there's going to be a lot more information flooding out, but it'll be very interesting to see just how strong, weak or moderate the European banking system is, and whether this is going to lead to a risk-averse open next week, or whether it's going to give people a feeling of optimism that the European banking system is not in as bad a shape as people fear, and they're actually in a good position to deal with any crises that follow. My fears are that it's more likely to be the former than the latter, especially given how much we're hearing about things like non-performing loans in the Italian banking sector currently. Aside from that, that's all we've got for this week. I hope everyone has a fantastic weekend. For more in-depth news and analysis, check out OANDA Market Pulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.